Okay guys, let's talk about stochastics now. Stochastics are very similar to RSI in a couple of ways, but there are some distinct differences. Now the first one is they're an oscillator. They're a momentum indicator and they're an oscillator. So in other words, they oscillate between the values of 0 and 100. You can't get higher than 100, you can't get lower than 0. And the same way with RSI, and they fall into an overbought and oversold condition. Now overbought, generally speaking, again being very broad with this, each person will approach this different, each trader will approach it with a different manner. Overbought is anything above 80 and oversold is anything below 20. So there's the general criteria for it. Now it's a momentum indicator, so as we discussed, momentum basically means how strong the price is moving. Now, there's a slight differences in formula, and again, if you want to really drill down into the specifics, go on Google, download some white papers, some thesis reports, all that kind of stuff if you really want to get dry with it. But I'm just going to show you from a trader's perspective how we can kind of use it and frame it to make better trades with, or avoid losing trades, or perhaps get in a better zone to take the trades. That's ultimately what it's all about, and for me that's what it's all about. So okay, let's look at this. So the difference is that stochastics take into account where the price closed relative to the range, as well as all the previous days trading, and you've got two lines. You've got a fast line and you've got a slow line. In this instance I've got them shaded in blue and in yellow just so you can see them on the screen. I think normal default colors are going to be something like red or purple, but you know what, it doesn't matter. That's not interested in colors, we're just interested in how it's going to pinpoint good trades for us. So what does it mean? So it's two moving averages basically. It's a moving average of the stochastic formula, a fast moving average and a slow moving average. And just like you'd use a moving average, traditional one on price, the higher the number you're using, the smoother it's going to be. So a 200 period moving average is very slow to catch up with price, and a 5 period moving average is very quick and sort of follows price a lot more aggressively. So that's the difference between an RSI and a stochastic. So let's have a look at some ideas. So generally speaking, you've got the first thing with all of these momentum indicators is that you have an overbought and you have an oversold condition. So overbought condition is anything above 80, as I said, and oversold is anything below 20. So how do you make that work? Same thing you do with the RSI. You identify a trend and then you look to fade the first counter trend cycle. So if you're in an uptrend and the price starts to go to the downside, you're looking then for the first oversold condition. Great example here on the FTSE at the beginning of the year and end of last year. Good short strong drive throughout December, a good move from 6,700 up to 7,300 on the FTSE 100. Counter trend move. Stochastics then goes oversold, and you're looking to buy that oversold area for the potential move back up to the highs. Okay, that's the broad way of looking at it. Now how to look at it a little bit more defined. So let's zoom in a bit. The good thing about stochastics is that you have this, as I say, the fast line and the slow line. Now what you can do is you can use the crossover point between the two to identify a bit more of an accurate area. Now I'm just going to use this example because, like I said before, I hate to cherry pick examples. Real world trading examples are not always perfect. You're going to get these examples, so we're going to stick with this theme throughout all the videos. FTSE 100 goes a nice drive up, push to the high side, starts to roll to the downside. Your idea being is that, okay, I've seen strength, I've seen momentum, I've seen a good overbought condition, and by the way, look how long that stayed overbought for, which is now you will never fade the initial strength momentum with an overbought trade. Never go short overbought. Let's quickly look at that. Actually, we first went overbought when the price was really 6,900. Is that? Yeah, 6,900 almost, maybe 7,000. Let's call it 7,000. And then we stayed overbought all the way up to this final sort of candle here, 7,300. So 300 points. You're sitting through all that. That is not the way to trade stochastics. You guessed that by now. So you're waiting for that first oversold cycle. So we get the momentum in one side, yep, check. We've got high overbought reading, check, indicating strength, price indicating strength, check, prolonged, check. Okay, first oversold conditions, wait for it. Now price starts to get oversold here, but we're not jumping the gun. The point is for stochastics is you're waiting for the fast line to cross over the slow line. Now this happens around here, which is this candle here, this first green candle here. That's when you get your first crossover. Now again, you get another crossover here, which is when your fast line crosses over here. So these are your two kind of entries. In fact, let me make sure that's exactly the right. We may as well look at it. So see this red candle here and this actually this red candle and this red candle here, let's draw them back on so we can see where we are with price. Again, never ever cherry picking or curve fitting things, because this is how we do it. Those are the worst arrows in the world. Sorry about that, guys, but you get the idea. That candle there, that candle there. So the point is, that's when you are looking to go long. Now, like the same with any of these indicators, blindly taking it is probably not your best bet. Your best bet is to say, hey, the stochastic has triggered long here. We're in a good zone. At the end of the day, you've got to give the stochastic credit. It gets you long in a pretty good area. It's a pretty good area to say, you know, I'm looking for a move back to highs, and ultimately, you know, we did get new highs from that, so very nice trade. Nothing can pinpoint, you know, with precision, ultimate precision, where you've got such limited risk in it. It's perfect every time, but it's guiding you. It's like all these indicators are guiding you. So you're taking it on the crossover here, or you're taking it on the crossover here. If you had a tight stop, my guess is you would have probably taken a stop as we push through the low on this one. Then when you got the second signal here, you take the long here, and that gets you long pretty close to the low. So your risk on that is not a lot, and your reward ultimately, if you're targeting the high, which is kind of what you should be, my premise anyway, if you're trading a first pullback type trade, is you look for that subsequent test of the high. I've got no qualms about taking it out as it attacks the high, to be cautious of a double top or scaling some out, but that's generally what you're looking for on that first pullback. Because again, digressing slightly, is first pullbacks normally take out the high, second pullback's a little bit broader, third pullback's a lot more, you know, long term, and that's when you sometimes get your topping pattern. So first pullback, if it's genuine momentum and strength, which we saw the clues indicating that, then, you know, we're going to take it. So that's exactly what you do. And if you want to go one step further, you can say, okay, as the stochastics cross over again, and it's fast, I'm going to take the trade out. So in reality, you go here, you're stopped out here. That's not a lot of stop. You go in here, you got your. By the way, you obviously want to check that you're oversold, and then as it crosses back over again in the overbought zone, which is here, we know, then we're taking the trade out. So that's giving us a nice chunk of the move for a nice swing trade. However, we may be trading that with trading a CFD or whatever it may be.